This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to the AIPIS show for accredited income property investment specialists and those who aspire to be. If you're a real estate, mortgage, or financial professional, this is the place for you. We'll explore innovative investment analysis, sales, marketing, and income-generating strategies for the most historically proven wealth creator, income property. Learn from the experts as they show you how to build a better business and a better life.
It's my pleasure to welcome Rob Stevens. He is co-founder of Avalara MyLodgeTax, and we're going to talk about tax compliance for short-term rental properties. Also talk about the marketplace in general. Rob, welcome.
Yeah, thanks for having me, Jason. Happy to be here.
Happy to have you. Where are you located?
We're in Denver, Colorado.
Okay, great. What is going on with the marketplace in the short-term rental world? When we were speaking off air for just a quick moment, I said that my impression, just anecdotally, was that the market is starting to get to a point where it might be oversupplied, where there are so many people converting properties into short-term rentals. Kind of has that feeling of a gold rush. And
Sure.
And you know how those always end. All manias end the same. It's just a question of when will they end. And you had kind of a counter to that. Go ahead and tell us what your thoughts are.
Yeah, I mean, I haven't necessarily broadly seen or heard that. And I've been doing this since 2000, or actually 1999, so almost 20 years. So the industry's very different than when I first got involved. But you're absolutely right. I think Airbnb, short-term renting, has really become ubiquitous. It's happening everywhere. There's tons and tons of people doing this. And so there's a lot more properties out there on the market for rent. But what I'm seeing, and I have my own short-term rental that I rent here in Vail, Colorado, and that my experience, at least for this little market for the winter, was I continue to get really strong bookings. So I think the websites have grown a lot, but I think they've done a really good job of driving a lot more travelers to the short-term rental option. You know, HomeAway used to do market research years ago, and even in 2010, 2011, there wasn't great awareness of short-term rentals as a category for travelers. And I think clearly, you know, Airbnb is really a household name. You know, HomeAway, VRB have become very, large, successful companies. So I think there's just a lot more travelers. So I think keeping up with kind of the supply side is the properties, the demand is the traveler side. So I think that equilibrium is relatively in check. Now, the other trend we're seeing is I think the market is certainly, as it matures and you've got more people doing it, we're also seeing a lot more serious people doing it. Like, for instance, Marriott announced that they're going big into the vacation rental space. They announced in the last week or two.
You'd think that a company like Marriott has been in the vacation rental space since their founding. They are a hotel after all.
Well, certainly on the hotel.
But I know what you're saying.
Right. In terms of adding the traditional short-term rental property to their mix. So that's another trend we're seeing is very professional,
institutional,
well-capitalized, branded operators coming to the space, providing a really, consistent and quality experience.
Okay. So before we get there, I'll just hold that Marriott thought for a minute, because I want to just go back to the equilibrium question. And I agree with you. There are a lot more travelers. There's a lot more bookings. But let's just look at what's gone on over the past decade or so. Since the rise of Airbnb and coming out of the Great Recession over the past decade, we have had a booming economy. Certainly there are chinks in the armor. I get that. But overall, I think, everyone would agree the economy is booming. And we've also had additional hotel construction. The hotels are still moving along. And we have increased the supply of travelers, but we have this really good economy with really low fuel cost, keeping airline prices and travel opportunities, transportation opportunities cheap. So what happens when we finally enter a recession, which we inevitably will, and maybe we see energy, fuel costs go up, and an overall slowdown in the economy? I mean, something has to give, right? The supply of travelers will likely decline. I don't track it closely, but my understanding is that the hotels are doing pretty well. Like, their occupancy is decent. So, either the hotels have to give up occupancy because it's shifting to short-term rentals, or there's just overall more demand, which I know there is, but will it continue? What's the future hold? And then let's talk about the institutional players and what that means.
Yeah, sure. Great question. And certainly to your point, at least for my corner of the world, I haven't seen, certainly short-term rentals has not been the demise of, the hotel operators. I think, they continue to grow and thrive. And certainly the vacation or the short-term rental industry is booming. So the pie must just be getting larger and larger. I think in the context of, you bring up a good point. It's been a great run for, over 10 years economically. And we do have some data going back to 2007, 2008, when we had the Great Recession. And, I was in the short-term rental space at the time. I don't think Airbnb had been founded yet, but certainly HomeAway was an established company operating. It'll be interesting to see what happens, because certainly it's clear when there's a recession or pullback, discretionary spending, obviously travel and vacations being one of those, is the first thing to go from the consumer. So travel is typically hit very hard in those environments. Now, how that falls out will be interesting, because what we saw as an industry in 2007-8 is, yes, a big pullback in consumer spending. But what happens is they'd go to drive-in markets, on the Gulf Coast rather than, fly to Hawaii or fly to the Caribbean. So people still want to take trips. They shorten them. They want to spend less money. In some sense, vacation rentals can be a really good option in that scenario. So I don't think anybody has a crystal ball, but certainly from 2007 and 8, short-term rentals really weathered that storm pretty well for some of the things I mentioned. People still like to take trips. So drive-in markets, more affordable properties you can share with families.
So they don't fly to a vacation. They take a road trip vacation, which is less expensive, but It's still more expensive than staying home. And there are still home exchange programs if someone wants to trade their house, right, rather than actually renting one and paying for basically two places at the same time. But it kind of begs the question, Rob, and here's the $64,000 question. Is it cheaper to stay in a short-term rental or a hotel? I don't know about that. Certainly for a big family, it's probably going to be cheaper to stay in a short-term rental. But for everybody else, I don't know. By the time you add these cleaning fees in and this and that, I know hotels nickel and dime you too, but hotels have gotten, they're not that expensive given all the bargain hotel sites out there and so forth.
Sure. Yeah, I think they're, in some segments, they're different products for different people. So I use hotels a lot when I travel for business, particularly 1-2 night stays. At least right now, vacation rentals, short-term rentals just don't seem like a great option for me. Certainly when I'm going anywhere for a week or with groups, if you're going with friends or a couple of friends or families or sharing a place, I do think it's a great option. Now there's very expensive short-term rental properties out there, but I think part of the value is the nightly rate, but part of the value is you have your own kitchen, you have multiple rooms, you have more space. So you're not, going out as much, going to restaurants. You have the ability to share the space, kind of spend time communally. That's the other part this industry will talk about is the community element. And I've stayed in hotels with my kids before, and they're in a separate room, and my wife and I are in a different room, or we're sharing a room, and that's not always a great experience. But look, hotels, to your point, hotels are continuing to grow. There's, for certain types of trips, that really makes sense. I think for other types of trips, short-term rentals are going to make a ton of sense.
Okay, so, I kind of wonder what's going on with the timeshare industry in all of this. I haven't heard much about it. Timeshares used to fill that sort of short-term rental, vacation ownership kind of a need. And of course, they've adapted and changed, and maybe they're a little less sleazy than they used to be, I think, and definitely more institutional. Certainly many big names in that world now, Marriott included, Ritz-Carlton, et cetera. But do you know anything about what's been going on with timeshares? Because most timeshares are more like a home. They're more like a condo. They've got a kitchen, they've got a laundry, all that.
Right. Anecdotally, we do bump into them. We have a few of them as customers of our business. But I think your general premise is correct that if you can go to an Airbnb or a VRBO website and you have millions of properties to choose from and kind of book now pretty easily online, conveniently, this has all become pretty easy to do. Do you really want to lock into kind of a timeshare investment when you have such a broad product offering anywhere in the world that you can stay at through these short-term rental sites.
Yeah. It's interesting. I think I wouldn't want to do that as much. Okay. Now let's talk about the institutional players, what you were getting at before. So what does it mean when, say, Marriott or, any of these larger players are entering the short-term rental market? I mean, how do you even classify them as entering the market? Are they buying single-family homes? Is Marriott buying a bunch of single-family homes and sticking them on Airbnb, or what are they doing?
Yeah, I don't know their exact strategy, but typically it's very rare that they would buy the physical asset or buy homes or condos. That's very expensive. I mean, they may control condo inventory at their resorts, but the typical model is to partner with property managers. And this is one of the big trends we're seeing. We're seeing companies like Marriott partner with multifamily operators. So, by multifamily, I mean people that own and operate apartments. And these are large, well-diversified real estate companies with huge inventories of apartments across the U.S. So that's where some of these larger and more branded operators are getting the inventory that they can then put in a short-term rental pool. And that's one of the big trends. I mean, the multifamily operators combined with these, branded operators like Marriott or a Sonder or Lyric, they're trying to create a real consistent guest experience, much like a hotel would. Like if you stay at a Marriott, you kind of know what you're getting versus a Holiday Inn. Well, that's the type of experience they want to create for vacation rentals: quality linens, quality furniture packages, maybe even concierge or guest services, very professional interactions. And so they're targeting, the traveler that's more serious, maybe the business traveler, sometimes the higher end traveler. But it's, from my perspective, it's really raising the bar across the industry. And I think going back to your original question, trends, I think this is all good for travelers, right? Travelers have more options now. They have, branded options. They can stay at a Marriott short-term rental. They can stay in a branded, like a Sonder, where they know what kind of experience they're going to get and have some services attached to it. So I believe the market's getting more difficult for the kind of casual or passive short-term rental owner, or the person that's just doing it sporadically or not putting a lot of effort into it. And this maybe connects back to your saturation point. So as the industry matures and the bar raises on the quality of properties, operators, and guest experience, you have to know what's going on if you're short-term renting and continue to create a quality experience and operate in a professional way if you're going to continue to succeed in this marketplace. So that's the other thing we're seeing. It's just the bar is being raised.
Yeah, okay. I'm just sort of wondering how you classify it as a short-term rental style property. It's obviously not a hotel room. You're saying it's an apartment, but it's not going to compete with the single-family home market.
Well, I mean, single-family homes are a big part of the short-term rental market, probably in resort locations. When you get into the cities, it's apartments, condominiums, properties like that.
Yeah, interesting. Anything else you want people to know about the marketplace overall, where it's going? And then let's talk about the tax compliance aspect.
Broadly speaking, and I've touched on some of this, I've been doing this for 20 years, Jason. And when I, first started renting my property in Vail, or if I rented a property from somebody, it was an offline. If I wanted to book it, I had to email them or call them. Usually you send a check to the mail. There was all this kind of offline clunky.
You go pick up a key somewhere. It's super clunky. Yeah,
exactly. And all that has really been streamlined. So whether you're a guest or an owner, I think it's gotten easier and easier to do. The industry is hugely popular and booming. To your point, probably in certain markets, it is getting to a point where how many more short-term rentals can you have? But I would, just encourage people that want to travel that way or have an extra property or want to try it. It's a lot easier now than it was even 5 or 10 years ago.
Yeah. But the ease, remember, this is what I always like to tell my listeners, there's always an equalizing factor to everything. So it is easier. You're absolutely right. The technology and, from everything from the platform sites where you can list the property and find guests to the electronic locks and smart home features, it's all made it a lot easier, and the fact that just the public has sort of accepted it as normal, just like we've accepted the idea of getting into some stranger's car, and not only getting into some stranger's car, but taking candy from him. It's funny what we've accepted as normal. It's really amazing the way the sharing economy has redefined the whole way we interact with things.
Yeah,
it's incredible. But because it's easier, you've lowered the bar, you've lowered the barrier to entry. It's easier for everybody, so it's easier to create more supply and have more people jump into the market as well, right?
Absolutely. I mean, a long time ago, I was in college, and you took an economics class, and supply and demand, you're absolutely right. Supply will continue into the marketplace at some point, for property owners, their nightly rental rates or their occupancy rate. They're just not going to be able to command as much dollars for that rental if it just keeps going. There is an equilibrium there. Maybe we've probably hit it in some markets. Mm-hmm. But at some point, people will keep entering, and the economic theory is that, the marginal benefit will keep going down. And, the risk is you hit a saturation point.
Yeah. Talk to us a little bit about tax compliance, what your company does, and what's new in that world.
Yeah, I mean, that's our little corner of the world in the industry. And as we've talked about, the industry become very, very large, popular, successful, lots of growth. But, for every one of these vacation rental transactions, for every booking, there's a hotel occupancy tax component to it. And it's not always well understood by the host or the homeowner. So, we see it as a real blind spot, and that's what that's basically our role in the marketplace, is to provide a online, cloud-based solution, for $20 a month, where we're going to handle all the registrations, all the forms, tell people the correct tax rate that they need to collect from their guest, and then, file and pay that tax, which is typically due every month or every quarter. So there's a lot of moving parts to these taxes that the rank and file person engaged in short-term renting isn't always aware of. They never dealt with it before. So again, it's a part of every transaction. We're here to help people solve it and make it very, very simple, and we leverage technology to do that. In terms of trends in our space, the big trend over the last couple of years, I think starting 2 or 3 years ago, Airbnb started directly collecting and remitting tax on behalf of hosts. So that's been a big change over the last couple of years, that the big platforms like VRBO and Airbnb have entered into the tax collection remittance game. So, now Airbnb is collecting and remitting in over 40 states. HomeAway has started to expand their tax compliance footprint. So, in some instances, that's great for the host. It's one less thing for them to worry about, if Airbnb is collecting and paying the tax instead of them. But what we're seeing is typically these platforms are paying the state taxes, but not city and county taxes. So, like here in Colorado, Airbnb has an agreement with the Colorado Department of Revenue where they pay the state, but they don't pay my town of Vail local taxes. So even though these platforms are paying some of the tax, in most cases, the host still has a obligation, which in some sense creates even kind of more confusion for what people need to do. And again, that's our role, to solve it and bring technology to bear to solve it. But tax compliance and taxes and regulations is a much, much bigger issue in the industry than when we spoke 4 years ago. But the market's changing with some of the platforms handling some of the obligation.
And so this is the same tax that hotels charge, right? You call it the occupancy tax. I think some call it the tourism tax, though, right?
Yeah, it's called different things in different states. It's, tourism tax in Florida. It's hotel tax in Texas. It's room tax in Oregon. It's sales tax in a lot of places. But yeah, it's by and large, it's the exact same tax that a hotel has to pay on the overnight stay, which I think we're all familiar checking into a hotel and paying that extra 10 or 15%. It's that same 10 or 15% that all of us in the short-term rental space have to collect for remit.
How much do these taxes differ from one area to another? I mean, of course, there's 50 states, well, 51 if you include Puerto Rico, and then there are just probably 400 local municipalities to tax. I mean, I don't know, maybe there's more than that.
Yeah, Jason, like 4,000 to 5,000.
Oh my God! Wow, I was kind of going by the number of counties or MSAs, I guess. Yeah, you can't do it that way. So, how much do they vary? I'd be curious to know. Interestingly, some of the generally considered low tax jurisdictions where you might want to move to have rather high tourism or hotel or occupancy or whatever you want to call it tax. Just speak to that for a moment. Maybe give us a couple interesting examples, if you would.
These taxes generally function pretty similarly across the U.S. The challenge with these taxes, like I mentioned, is you've got thousands of different tax jurisdictions with their own tax. So it's all pretty similar. You got to register and, collect the tax, pay it monthly, that type of thing. But it's different for each city and county. And that's the real complexity there. These are state taxes, but also city and county taxes. So they vary all over the U.S. And typically, it's the urban markets. I would say that these taxes average 10 to 12%. And this is a tax on the rent. So if you charge your guests $1,000, it's an extra, $100 to $120 in tax. Well, when you get into urban markets, you start to encounter very high tax rates, typically, 15% or higher. Chicago is probably on the far end of the spectrum right now with, I think, over a 23% tax on short-term rentals. So that's very high. But it's very common when you get into urban markets with lots of hotels, lots of business travelers, transient activity, that you have high tax rates. I mean, look, it's a great revenue source for a lot of municipalities because it's a tax that the local community doesn't pay. It's a tax on visitors and travelers. So it's the classic, the hotel tax, the car rental tax is always very high in these communities. In the urban communities, they can be very high taxes.
Interesting. I almost think, and when I asked you that question, I was almost wanted to recommend that as a strategy for tourists. I mean, look, now people are getting sophisticated enough, and I've recommended in my show for many years that people get themselves out of high tax jurisdictions and, make a plan to, at some point, hopefully in the near future, move to a no income tax state or a lower income tax state. But now I think it's even worth considering shopping that as a tourist because it can be pretty significant. I remember once renting a car, for example, in one of my favorite places where I did live for 6 years. I was in Scottsdale, Arizona. I posted a screenshot of my rental car bill on Facebook because I was so astonished that the tax was 69% of the overall car rental fee. I mean, actually, the cost of renting the car was 31%. I was astounded. I couldn't believe what I was reading. Any thoughts?
Yeah, I think me and everyone listening to this are probably nodding their heads. We all have that experience with these types of taxes. Now,
I mean, when the government is making more on the deal than the actual company, I really feel sorry for the company.
Hotel tax, I don't think there's certainly no hotel tax that's 50% or 60% or anything close to that, just because, look, hotels are a big ticket item. Typically, if you're staying in an urban market, it's hard anywhere in this economy to stay, for a decent, hotel for less than $200 or $300 a night. But again, in the urban markets, it's very common. It's a 15 to 20% tax. So I think we're all as consumers, when we're traveling, there's the quoted rate. And then when we check out, it's just always higher and sometimes significantly higher just because of these taxes. And like I said, it's a great revenue source for municipalities that have a lot of hotels and travelers.
Yeah, interesting stuff. Anything else you want to share before you wrap up?
I don't think so. Just as I mentioned before, short-term rentings become very popular. It's gotten very easy. So I would just encourage people to try it, whether they're a traveler or if they want to jump into it as a homeowner. And if they're looking for help with the compliance side of it, that's our role in the world.
Good stuff. Rob, give out your website.
Jason, thanks for having me.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.